Everyone out there, welcome into another edition of Market Takes. I'm your host, Dion Rabouin, reporter at the Wall Street Journal. As you see, we are swagged up today. We got a bunch of surprises, exciting stuff in store for you today, but we are talking about the third quarter U.S. GDP report, gross domestic product, what the U.S. made, what it lost, what it earned. And for those of you who are, excited about economic growth, you got reason to be excited today. After two straight quarters of negative GDP growth, we are back on the positive side and back on the positive side in a solid way. We're going to get into all of that. We're going to talk about a lot of things within this report. We're going to talk about the headline numbers, of course. We're going to look at the markets, talk about the market reaction from that, stocks, bonds, commodities, currencies, crypto. We're going to do all of that. We're going to talk about how this GDP report compared with the expectations that we had coming in, as well as how it fits with other data we've seen from the third quarter, what that can tell us about maybe the fourth quarter, the year so far, all that good stuff. We're also going to talk about what this means for the market as well as for the economy, because as we know, those two things have not been, on the level with one another in the recent past few years. And of course, we're going to talk about what to watch for next. That's going to be big. And we'll get into what you need to look for now that we've gotten this report that was highly anticipated and what goes next. Before we jump into all that, though, there's another big thing happening this morning. That's the European Central Bank just announced they're raising rates by 75 basis points or 0.75 percentage point, as we say here at the Journal for some reason. So that's another thing that you've got to watch out for. This was largely in line with expectations, but ECB President Christine Lagarde is speaking right now. So that's going to have some effect on other markets, in particular, the value of the US dollar. So keep that in mind when we're talking through what's going on in markets today, because the ECB is catching up. They're at least raising rates right now. Their rate is 1.5% compared to the Fed at 3.25%, and Fed's expected to get to 4% next week. Again, just something to keep in mind as we look out at the markets and the overall. You got to look at everything, right? The big picture. So let's jump into this GDP report, because that's why you're all here. We're talking about that and what's going on. US GDP in the third quarter rose by 2.6%. And I want to just bring up a chart. That's right, we got charts, ladies and gentlemen, to show you and just illustrate a few things. Going back 10 years, as you see this chart on your screen, you can see GDP has been, pretty small. We've been inching up a little bit. If you take out those big swings in 2020, right? We all remember Q1, Q2, Q3 of 2020. That's the pandemic lockdowns and then the big get back from that. But then the last two quarters before this quarter, you saw are negative. But they're small negatives. Remember, aside from that 2020 period, we hadn't seen a negative quarter of growth since 2014. So those two negative back-to-back quarters of GDP growth were really worrisome for a lot of people. And now you see that pickup there at the end on the right side. So just wanted to show you that to illustrate where we've been and where we are, and just why we are where we are now and why this report was so important. Look, the big thing from the report, I want to read you a little bit from the report. What it said was the increase in real GDP reflected increases in exports, consumer spending, non-residential fixed investment, federal government spending, state and local government spending. There were decreases in fixed investment, private inventory, but there was a subtraction from imports, meaning we increased exports, decreased imports. That's a good thing for GDP. The big picture, what all that stuff means is just about everything increased. You saw a pretty solid number. If we'd gotten this number back in 2019 or 2018, pre-pandemic, this would have been a solid report and something that you could hang your hat on and feel pretty good about where the economy was headed. But we are not in 2018 or 2019 right now. We are in an environment where the Federal Reserve is trying to slow down growth, is trying to really rein in the economy and kind of choke off some of that growth so that inflation can come back down. And that really is priority number one for the market, because how goes the Fed is how goes the market. And we've seen that recently. There's been some expectations for the Fed to kind of chill out a little bit. We're going to talk about how this report is going to factor into what we expect to hear from them next week at their November meeting, as well as what we can expect to hear in December at that meeting. So economic growth and the health of the economy looking solid from this report. After those two negative reports that we saw in the first and second quarter, this report suggests things are getting better. The recession debate. If we had had a third quarter of negative growth, which it looked like we might as recently as September, that would have been a real bad thing in terms of, wow, we are going into a recession if we're not already in a recession, if we've not already had a recession. That's for the National Bureau of Economic Research to decide. I don't get a say. But we did have those 2 quarters of negative economic growth. Now we have rebounded very clearly from that, up 2.6%. That's quarterly GDP up 2.6% after those two negative quarters. So for the market, the Fed is going to be diving into this very closely. And I'm going to talk to you about what the Fed will be looking for as it reads through it and dives into this report just a little bit later. Also notable that core PCE inflation came in as expected, 4.5%. So not jumping off the charts, not an upside surprise as we have seen from the recent PCE and CPI inflation reports. That's definitely a good thing for the market and something that folks out there, investors, traders, can take a little bit of solace in terms of when they look out at the market and what's going on. As we look out at the stock market right now and at the overall market, Dow Jones Industrial Average is booming, up 1.3%. The S&P 500 up about 0.5%. The Nasdaq up just a little bit, 0.06%. The stock market really not where the big action is, except for that Dow print. Keep an eye on that. We had those big negative numbers from Microsoft, Facebook, a couple others yesterday on the tech side. So the Nasdaq really being dragged down by some individual stories. But if you look at it, the Dow, boom, up 1.3% today. When we look at it, bonds, that's where I think the really interesting story is. You've got a big dive in yields at the longer end of the curve and really across the board with the bond market. You see that right around that 8 o'clock, 8:30 time, right around that 8:30 time when we got the release of the GDP data. You're just seeing a big turn down in bond prices. Bond prices have been coming down for a while as expectations for the Fed not to raise their rates up to 5, 6, 7%. A lot of folks were worried about buying bonds because they're saying, we don't know when the Fed's going to stop. We don't know how much hiking they're going to do. This report seems to have put a little bit of confidence back in the bond market as we see folks going out buying those bonds. Bond yields go down as prices rise. So we are seeing a lot of buying in the price change. You're seeing at the 10-year, actually, up 23 basis points today on the price side. That's a big move for the 10-year. And also, with the other big market that folks have been talking about, and maybe not talking about enough as far as I'm concerned, is the dollar. You're seeing the euro down 0.75% against the dollar. The WSJ dollar index only up 0.34, but the US dollar index up 0.63. US dollar index a lot more motivated and moved by the price change in the euro. Right now, folks really not liking what they're hearing from ECB President Christine Lagarde in terms of euro bulls. They're selling the euro down about 0.75 versus the dollar. But most other currencies kind of holding firm. So you're seeing the dollar only up about 0.3%. So as we sort of step back, right, from the market reaction, because this report, it moved things, but it wasn't a huge move. This was kind of like the market saying, okay, because what the market was really worried about was this report was going to be too hot, that the number was going to come in and GDP was going to be too strong, that we were going to have something 3 or 3.5%. That also showed that inflation was still picking up, that folks are still spending money. What we're seeing is what the Fed is doing with trying to kind of choke off some of that economic growth looks to have been working in the third quarter, which means the Fed can kind of relax a little bit. They don't maybe need to do quite as much this year and then going into 2023. And that was what investors were really worried about. So up above expectations, 2.6 versus 2.0%, which is what we had on FactSet. Some other folks were saying 2.4. Depending on which economist you talk to, that number can move, but 2.6% beating expectations. And like I said, as recently as September 27th, there were expectations for GDP to only be 0.3%. Then we saw some numbers on, let's see, what was it here? Gross private domestic investment. That was huge, as well as the PCE, that inflation report that we saw in late September. That pushed us up to about 2.3%. And the expectations went up from there. And today we got 2.6%. Checking out some of the details within the report because those matter. The GDP deflator. Now, if you're not an economics nerd, you probably don't follow that super closely. That was way down to 4.1%. Now, that's huge because it was at 9% in the second quarter. That basically, GDP deflator is a measure of inflation. And the higher that number is, the more inflation is contributing to GDP. So in the second quarter, you had a negative print, negative 0.6% GDP growth in the second quarter, but you had 9% on the GDP deflator. This month, we've got 2.6% positive growth and only 4.1% on the GDP deflator. That's big in terms of saying inflation is starting to cool down. And the GDP deflator doesn't measure a basket of goods. It's just everything that was produced in the economy. What were the prices? How was it moving? And that's definitely a good sign. So the Fed can take some solace from that GDP price deflator. It's also considered more comprehensive than the consumer price index. So, we saw that report from Nick Timrose, my colleague here at the Wall Street Journal, saying the Fed is looking to raise 75 basis points in November, but then slow its roll in December, and that there are some folks worried about what's going to come next year. This really backs the case for the Fed to kind of slow its roll and chill out a little bit, maybe not have to raise rates quite so high, not have to do quite so much to choke off growth in the economy. Look, we have seen a continued slowdown in jobs report. The Fed, for whatever reason, has pointed to jobs growth. Even though we have seen wages not growing as fast as inflation, we've seen a real slowdown in wage growth, even as overall inflation has continued to stay high. But the Fed has pointed to that, and we have seen slowing job growth. We have also seen retail sales flattening out, but not going negative, not turning into a negative report. So overall, the economy is looking like from this report that we could see higher odds or higher likelihood of that soft landing that the Fed really wants to achieve, where they bring inflation down, but they don't choke off growth and don't send us into a painful recession. Really, what a lot of economists are saying right now is that it's not a matter of whether we'll have a recession, it's a matter of how bad or how painful that recession will be. Well, from the looks of this Q3 report, the recession might not be that painful. Things can continue moving as they have been. But again, remember, economic policy and monetary policy in particular works on a lag. So when the Federal Reserve raises interest rates, as they've been doing since March of this year, every single meeting, that works in a lag. It doesn't hit the economy right away. So you could see the impact from those rate hikes that they've been doing all year and will continue to do through December, as they've suggested, start to hit the economy in 2023, and we don't really know what the impact is going to be. The big takeaway, look, this suggests that the market and the economy, I'm sorry, not the market. This suggests that the economy is in pretty good shape and that inflation did start to slow down, and that some of the things the Federal Reserve wants to see are happening within the economy. That GDP deflator is going to be big. PCE core coming in on the nose at 4.5%. That's good. There's really not a lot in this report that you can look to that says, okay, the Fed needs to be more aggressive. And that's what the market and Wall Street wants to see in terms of stocks getting better. Look, we have seen stock prices really kind of pick up consistently since October 12th. And this really gives Wall Street another reason to say, hey, maybe things aren't so bad. Let's go out and buy stocks. So what to watch for in the future after we've gotten this report? Now that we've kind of settled in, we've said, okay, GDP is backward looking. We know what happened. Q3 was probably, maybe a small win, but a win for the Federal Reserve. What's next? Well, the Fed's going to talk to us on November 2nd. That's next Wednesday. Be right here. We'll be talking through it on Market Takes. I'll be with you. Hopefully you'll be with me. We'll be on YouTube talking through that meeting, talking about the report, what we hear from Fed Chair Powell at his press conference, all that, and getting into everything there, as well as the next report after that is going to be the jobs report on Friday. So you got the Fed meeting and the jobs report next week. Could be a very momentous week for the market. All eyes will be on Fed Chair Jerome Powell next week on Wednesday, November 2nd. Hopefully all eyes will be here on Market Takes from y'all. I look forward to seeing you then. And of course, the other thing to look out for before we get into next week, tomorrow, the employment cost index is out on Friday. Check that out. Make sure you're watching that because the Fed pays a lot of attention to that. Like I said, they've pointed out the increase in wages and jobs and said that's a thing that we need to choke off. Look out for that if you're watching the market. Hey, like I said, our next live stream here on Market Takes is going to be next Wednesday, November 2nd, or Wednesday, November 2nd, talking about the Fed. I hope you'll be there and you won't be that's a square. Don't do it. Listen, I am Dion Rabouin for the Wall Street Journal. That's going to do us here for us on Market Takes. Hope you'll be with us next time.